The Fibonacci ratios are a super powerful tool that can help traders in identifying market reversals with high accuracy. This tool is very popular among technical traders, however, the vast majority of them do not know exactly how to use it in the right way, which causes a lot of frustration and blown up accounts. So in today's video, I will first explain what the Fibonacci ratios are, and then I will give you some of the best strategies with this tool that will instantly make you a profitable trader. So make sure you watch this video till the end, as the information I'm about to present in this video should not be for free on YouTube. Okay, without further ado, let's get into it. So first, let's understand the basics of the Fibonacci or the Fibonacci ratios. Fibonacci ratios origin from Fibonacci number series. History says the Fibonacci numbers were created by an Italian mathematician named Leonardo Pisano. The numbers start from 0 and then they keep on adding the values of the previous two numbers in the sequence. For example, 0 plus 1 is equal to 1, then 1 plus 1 equals 2, 2 plus 1 equals 3, and so on and so on. This basically tells us that any given Fibonacci number is the sum of the previous two Fibonacci numbers. You might be asking why these numbers are so important. And the answer is this: these numbers appear in various aspects of the universe. They are found in architecture, nature, and even facial features. One of the remarkable characteristics of this numerical sequence is that each number is approximately 1.618 times greater than the preceding number. This common relationship between every number in the series is the foundation of the ratios used by technical traders to determine retracement levels. The 1.618 ratio is often called the golden ratio. Now let's understand how we can utilize the Fibonacci numbers in our trading. If you've been trading for a while, you already know that the price of any asset doesn't move in a straight line. It always moves in waves. Every time the price action makes a huge move, there is also a pullback to follow. Our goal is to catch these big moves, so ideally we want to enter a long position when the price makes a retraction or a pullback so that we catch this continuation trend. The only problem is, how do we know exactly that the pullback is over? So in this example, we see the price is in an uptrend, it makes a huge upward move, and then it creates a pullback. The Fibonacci tool basically helps us identify the level of support the price action could potentially find when making a pullback. Here we see the price action bounced off the 61.8 level twice. At the same time, when the price action is in a downtrend, we see that it first makes a huge downward move and then the pullback occurs. The Fibonacci will help us identify the potential level of resistance where the pullback might come to an end and the continuation downtrend will happen. You see, the Fibonacci retracement tool consists of multiple levels, but most of them are pretty much useless. So my recommendation would be to only use the top two levels, which are 38.2 and 61.8. You can remove all the unnecessary levels by accessing the Fibonacci settings and disabling them, just like I'm doing right now. Okay, now let's understand how to properly plot the retracement tool. When the price is in an uptrend, we first need to identify the recent major swing low. In the example you're seeing right now, the recent major swing low level would be this one right here. Next step will be to identify the recent major swing high, which is this point. Now we need to select the Fibonacci retracement tool and plot it from the low of the swing low to the high of the swing high. The two lines that we get in the middle are the Fibonacci retracement levels. In the uptrend, the price will find support at these levels. As we can see, the price found the support exactly at the 61.8 level. So if we had entered a long position at this price, we would have closed this trade with a really nice profit. Exactly opposite is true for a downtrend. First, we need to identify the recent major swing high. We can see it's this level right here. Then we need to identify the recent swing low. Once we know these major levels, we need to draw the Fibonacci retracement starting from the high of the recent swing high to the low of the recent swing low. And because the price is in a downtrend, these two lines we get from Fibonacci will act as resistance levels. And as we can see, the price found a resistance at the 61.8 level. However, most of the times in a strong downtrend, the price will respect the 38.2 level, as the price action does not form massive pullbacks. Okay, so these were the basics of the Fibonacci levels. Now let's learn some super powerful Fibonacci strategies you can use with this tool for maximum profits. For the first strategy, we will use the Fibonacci retracement tool with an exponential moving average. This is a highly accurate trend following strategy even a beginner can use. It also works on all markets and it's suitable for scalping. First, we're only going to be looking to sell when the price action is closed below the exponential moving average. Second, we need to draw the Fibonacci retracement tool from the recent swing high to the recent swing low. Third, the price action has to pull back into one of these two Fibonacci levels, and it also has to touch the exponential moving average. As we all know, the EMA acts as a support and resistance, so this is literally a double confirmation that the price is more likely to reverse. And to get a final confirmation to enter a short position, the price action has to cross and close below the 38.2 Fibonacci level. Our stop loss can be set at the 61.8 level. And for this strategy, we can be targeting 2 times the risk. We can see how quickly the price action triggers our take profit target. Exactly opposite rules apply for long trades. First, we're only going to be looking to buy if the price action is closed above the 200 EMA. Second, we need to draw the Fibonacci from the recent swing low to the recent swing high. Third, the price action has to pull back into one of these levels and it also has to touch the exponential moving average. And to confirm the long entry, the candlestick has to cross and close above the 38.2 level. Our stop loss can be set at the 61.8 level. And we're going to be targeting 2 times the risk. If you're struggling to find the major swing low and swing high levels, you can use an indicator called higher high, lower low strategy. This indicator by Lonesome the Blue. Obviously, you need to make some adjustments first. So in the star section, remove everything except for this higher high and lower low. This indicator makes it so much easier to find the recent levels of swing high and the swing low. Okay, now let's move on to the strategy number 2. For the second strategy, you first need to switch the candlesticks from Japanese to Heikin Ashi. And you need to add an indicator called support and resistance. Support and resistance levels with breaks by Lux Algo. This is an amazing tool, and with its help we can identify the trend direction. In order to identify the uptrend, you need to wait for the price action to break above the recent level of resistance. Once we have that, we can draw the Fibonacci from the recent swing low to the recent swing high. Next condition will be to have the price pull back into one of these two levels. It can either be 38.2 or 61.8. And for a final confirmation to enter a long position, you're going to be using the bullish Heikin Ashi candlestick that has no lower wick. You can set your stop loss at the recent level of resistance. Of course, if you want to stay more consistent with your stop losses, you can use an ATR indicator instead. And for this strategy, you can either be targeting 1.5 or 2 times the risk. Exactly opposite is true for short positions. First, you want to see the price action breaking below the recent level of support. Next step will be to draw the Fibonacci retracement tool from the recent swing high to the recent swing low. Then we're going to be waiting for the price action to pull back into one of these two Fibonacci retracement levels. Just like I mentioned earlier, if the price action is in a strong downtrend, the price will usually pull back into 38.2 level. And to confirm the short entry, you need to wait for a bearish Heikin Ashi candlestick that has no upper wick. Your stop loss can either be set at the recent level of support, or you can simply use an ATR indicator. And just like with the long trades, you can be targeting 1.5 or 2 times the risk. We see we're not catching reversals, we're literally going with the trend, and by doing that, we're maximizing our chances of success. Okay traders, I think that's going to be it for this video. I hope you found it useful. If you could spend 1 second of your time and like it, I would appreciate that a lot. Also, if you want to see some of the best indicator strategies on my channel for Forex, make sure you check out this playlist right here.